All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The state of play for stocks. The mega caps are now out of the way. The election and the Fed are looming large. We'll strategize with the investment committee on this Friday. Joining me for the hour, Josh Brown, Bryn Talkington, Stephen Weiss, and Jim Lebenthal. We will check the markets. We got a really nice day shaping up. The jobs report was an obvious miss. You knew it was going to be noisy because of the Boeing strike and the storms. Unemployment rate stays the same. NASDAQ's going to snap a 7-week win streak because we have had that reaction yesterday to Meta and Microsoft. Weiss, I'll turn to you first. I mean, what did we learn this week, do you think, that shapes the road ahead for stocks? Just have 2 months left in this great year for returns.
Well, what we learned so far is that earnings is okay. It's not blowing anybody away. So we've got to take the strength that we have and continue to play in those names that are strong. So yeah, we saw like 3% sell off in Meta and Microsoft yesterday. Who cares? Given where those stocks have come from, who cares? That's nothing. What we did see there is that there's continued strength. There's accelerating strength in certain parts of their business, and the AI theme is not just, pomp and circumstance. It's real.
Oh, it's legit.
They're spending, and you've got to pay attention to it and be judicious where you invest in that theme. So that's what I took from it. But of course, depending on what happens in the election and the aftermath, we throw all that in the window in the short term.
That's why it's it's obviously difficult to try and game out the next 5 to 10 days. We just have to wait and see. But Bryn, let's deal with what we have, right? You play the cards that are in the hands you got. What did we learn, do you think, this week that shapes your view about what these last couple months could hold?
Well, I think for the hyperscalers, we learned that the cloud business, the pie is getting bigger. So Google definitely doing a great job. They're finally profitable. So, I was skeptical of Google. Definitely wrong about that. They're growing. AWS is growing, Azure's growing. They're growing at different rates. So that overall pie is growing. I think what we also learned, I loved what Satya Nadella said. He said, we obviously have data center constraints, but hardware is not keeping up with demand. And so to me, to really echo what Steve said, I think this whole AI narrative, the data centers, really plays into the Dells, the NVIDIAs, the Vertivs. You can have that whole ecosystem. I still feel like it's going to be a multi-year spend here from what all of them said this week.
Josh, right? I mean, if anything, maybe if nothing else, we just underscored this week the investment community, right? These CEOs of these mega cap tech companies just underscored why there's been such excitement over AI, why these trades have, for the most part, worked so well, and why they continue to draw all the oxygen in the room.
Yeah, I think I found myself agreeing with Bryn and Weiss, but I want to add another wrinkle to the conversation. I want to think a little bit about where the puck is going. So Amazon just said they're going to make a $75 billion total CapEx expenditure for 2024 and plans for, quote, more in 2025. The more is interesting. I think where the puck is going is this year was more like a sandbox. Everybody announced huge plans on how they would spend, and there weren't huge questions yet about ROI, at least not so granular or on a quarterly basis. I think that's what changes in 2025. I think we're going to see a separation of the hyperscalers and the big tech companies that can actually put up some results and the ones that are still in the sandbox. So the good news is we're not there yet. You look at the results of Alphabet. So this is a name I'm in. I trimmed a little bit ahead of the earnings. It had a huge pop after the earnings. Congrats to Weiss. He nailed it. The setup was perfect for that. But I want you to look at the 5 days, the week on Alphabet, because it's given back the entire pop. It's down 10 points from right after they reported earnings. And I think there's still a lot of skepticism that the money that they're spending is going to come back to shareholders in a tangible way. Are they really going to grow because of AI, or are they just going to cannibalize the existing search business and replace one thing with another? So I think it's going to get tougher as we get into 25, not just for Alphabet, but for all of these names It is nice to see Amazon print an all-time high here. This was a name that was 7% below that all-time high, and now we're making a fresh record. It is nice to hear all these spending plans. I just think it gets harder, not easier, as we start to ask these companies, okay, so you spent all this money. We said, okay, what do you got?
Yeah, Jimmy, it's not like these stocks more recently had been trading like a monolith anymore anyway. But maybe this is the week that puts the exclamation point on the fact that you're going to have these stocks diverging from one another in the months ahead, because their businesses are different. Their investments towards certain things are different. Most importantly, their return on the way they're investing is different. And we learned that, I think, this week.
That's exactly what I believe, Scott. I mean, you put it very well. Within the Mag 7, to use your words, I don't think it's a monolith. I think there are some that will be bigger winners than others. I don't think any of them are terrible stocks. But, in terms of where the biggest winner probably is likely to be, it's likely to be NVIDIA. When we talk about all these CapEx plans, I don't care whether it's Meta or Amazon, the bulk of that is going to NVIDIA. However, to your comment, which I strongly agree with, that it's not a monolith, I don't think anything in this market is a monolith. I don't think there's any sector that you can look at and say, I just want to go in on the sector. And I can use countless examples here. You can look in the automotive industry, the divergence between Ford and GM. You can look in the airline industry, the divergence between a JetBlue and a Delta. You can look at retail and the divergence between a Costco and a Target. I could go on and on. I like this. This is a stock picker's market. Now, there will be mistakes. You, I, Steve, Josh Bryn, we may choose a stock that doesn't do as well as others, but it's highly likely that most of our picks are likely to be right. That's what stock pickers do.
Let's get down into Amazon a little bit. They really crushed it, I think is fair to say. CEO Andy Jassy called investing in AI a, quote, once-in-a-lifetime opportunity, said they'll aggressively pursue that. Thought the way that our Kate Rooney put this was just perfect, and she joins us now, to which you describe this as they really threaded the needle. Explain to us why that was your takeaway.
Yeah, Scott, so it was really this delicate balance for Amazon. They were able to show an ability to be hugely profitable while at the same time still investing in growth, and AWS, as you guys have been talking about, margin expansion and better operating profits were one bright spot, especially in Amazon's retail business. And then overall operating income grew 129% year over year. That really does highlight some of the cost-cutting efforts paying off. And then the ad business, too, was strong. That all-important cloud business, though, AWS grew 19% year over year with 38% margins. Some really bullish commentary on the call as well. You had CEO Andy Jassy saying that AI is now a multi-billion-dollar run rate business, growing triple-digit percentages year over year. He called it an unusually large, maybe once-in-a-lifetime opportunity. Quote, shareholders will feel good, he says, in the long term that we are aggressively pursuing it. A big part of that aggressive strategy, CapEx. So for the year, he says it's going to be around $75 billion and suspects that they will spend even more than that next year, Scott.
Kate, thank you for that. Just perfectly set up, because Josh, when Kate says that, what Jassy told investors that they're going to feel great about it in the future, you feel great about it today. That even though their CapEx surges 81%, they're able to show return on that investment. And whatever way they've been able to do what Kate said, thread the needle, it seems to be working.
Well, yeah, here's a textbook example. Amazon did $1.43 in earnings per share on $158.9 billion in revenue. They beat the revenue number by 1%. They beat the earnings per share number by 25%. There you go. That's an example of the company pulling the levers that it has, I assume utilizing AI not just on behalf of clients, but internally to improve profitability. And they don't have to grow top line by 20% the way they used to. It's unnecessary because they're able to generate that return on investment via higher profitability. And if you're a shareholder in this company, your expectations should not be 20, 30, 40% top line growth. It's just unrealistic given the scale of this thing. So I like that message, and I think it's good enough. Look at the stock. It's good enough for investors today.
Yeah, clearly, Weiss, right? I mean, Truist today goes to a street high 270. The stock's at 200. That's what we'll call it 200, right? They go to 270. That's street high. JPM goes to 250, Citi 252, Wedbush 250. Most of the targets are around there, but Truist isn't afraid to go out on a limb and suggest it can go even higher than that. And they say that management earned the right to invest aggressively, which, as we just said, as Kate did and we reiterated to you, Jassy made no apologies about what they're going to spend.
Nor should he. And we had that this conversation with Meta a couple of quarters ago, where we said, or I said, they're investing in their future, which is why I size up the position. Where's the growth going to come from? And what they're doing is, whether it's Amazon or Meta or Microsoft or Google, they're continuing to reinforce that moat. Name other companies that can possibly make that size investment. Right, so it's unusual. I don't like getting in front of CapEx cycles. I wait for them to be done so I can bear the fruit of it. But the return on the AI investment is so immediate, you don't want to take that strategy. Now, what I'd say is, and going back to Jim's conversation on comments on NVIDIA, you want to go to the tool belt also. And the tool belt, to me, doesn't really include OpenAI. It's private, but the valuation's just so crazy. We don't know who's going to win there. Because there are so many others there. So look at things like Vertiv, right? That's part of the tool belt. So to the extent you build more data centers, which you have to, you need more cooling racks. Take a look at Taiwan Semi. That's doubling down on who benefits. Yes, NVIDIA benefits, right? But everybody building their own chips, all the chips, Taiwan's making, including for NVIDIA. So there are plenty of ways to play it that aren't nosebleed valuations in addition to the mega cap stocks.
One of your takeaways this week was you added to Meta, correct?
Yeah.
Which was one of your core positions.
Yeah.
So you saw enough, or at least saw a sell-off attractive enough that you wanted to add to the stock. Tell us more.
Yeah, so I added a trading position to it, as I did with Netflix, Meta, and others when they sell off. It wasn't as big a sell-off as I would have liked, so it wasn't a super add to it. And I'll be there for a little while, but I thought the quarter's extraordinary. I mean, when you take a look at all the shots, justifiably in terms of their business over the years, and how Zuckerberg has learned from them and come through them and managed even better than he had before. So he's truly not just a visionary, but he's truly just a great operator. So I love the fact they're spending on AI. I love the fact that all their business pretty much are moving higher and will continue to be. And just turning to Google for a second, addressing Josh's comments, I don't disagree. I mean, I was disappointed that the stock didn't get some believers, and it not only held that high, but moved up higher. But what I'd say is that I have faith that the money they're spending is not just defensive, but it's going to be offensive. We truly don't know what the business use cases are for AI, but they will find out before you and I find out. So that's why I'm glad they're spending. I still think trading where it is below a market multiple, that it's a pretty compelling value.
Let's move to Apple, which was okay, right? Yeah. I mean, it was okay. Sales hit a record, services missed. Didn't learn that much about AI demand. Maybe that's the greatest takeaway. Steve Kovac, obviously following that, he was in Cupertino, spoke to Tim Cook. Is that the right takeaway? Maybe the market today gives them a breakfast ball, so to speak, from a golf analogy, right? We know what's coming still, so just it's all right if you hit one in the trees.
That's exactly right, Scott. So, and it's also because Tim Cook didn't really tell investors what they wanted to hear on the call. Basically, they wanted to hear Apple Intelligence is driving increased iPhone sales, and we just don't know if that's true yet. I did catch up with Tim Cook yesterday, and he gave me some nuggets of info, at least, hinting at early momentum for Apple Intelligence and the iPhone 16. Here are my two main takeaways from that conversation. First, he told me several days of iPhone 16 sales in the quarter were better than the iPhone 15 sales for that same year ago, or same period a year ago, that is. And secondly, he told me more people have updated to iOS 18.1. That's the first software update that came out Monday with Apple Intelligence than the same version a year ago. Basically implied that shows excitement around Apple Intelligence. He also told me they're tracking how many people after that upgrade actually switch on Apple Intelligence, but so far won't be disclosing those numbers. Another interesting bit here, services. Like you said, revenue did miss estimates, but it still grew by double-digit percentage points, and Apple now says it's a $100 billion annual run rate. Look at that chart right there, Scott.
Yeah, wow. Steve, thank you very much for that setup for us as I go to Bryn now. I think we've learned throughout the years, Bryn, that Tim Cook and Apple, they get the benefit of the doubt. They have the Apple Intelligence, which is still in its nascent stages. We haven't even sniffed the upgrade cycle yet that we still believe is going to come. If Tim Cook is talking about the excitement around Apple Intelligence, okay, all right, let's see it. Let's see it.
Let's see it, right. And so I think that, I mean, as I've been saying, I think a lot of us on the panel, that this doesn't seem like it's a super cycle. To me, the super cycles were in the early days, 2010, 2011, 2012. I think ultimately people will upgrade to the 16 in the US. And so is this Apple Intelligence in China? I don't think so. Is it in Indonesia? I don't think so. And so it's like, US is what, 45% of their business? They have a big business overseas. And so really you would want to see over time this consistency globally of the upgrade. And I think they're going to continue to sell very well. But I think this stock will just be a market performer. I do think this is the one company of all of the mega caps that we talk about that it's AI explicitly for the consumer. And how much and how quickly are we going to adopt this 16 Pro for that we don't necessarily need to like upgrade our pictures or what have you. Microsoft, Google, and Amazon are doing enterprise. And so to me, this is a really play on the consumer, and we'll see how that upgrade cycle actually goes over the next couple of quarters.
Yeah, Jimmy, range bound is what Morgan Stanley says shares are likely to do in the near term. They think downside's limited. Eric Woodring, by the way, the Morgan Stanley analyst on Apple, is going to join me later today on Closing Bell. So we'll get into it a little bit deeper. But there's the stock down 1 2/3%. Bernstein says range bound. UBS talks about demand being muted for the iPhone, as does Barclays. They use the same word. KeyBank suggests expectations should reset lower. What's your view here?
I'll go with range bound as well. I do own the stock. I own it well below the market weight, which is my way of saying that I think it'll do fine. I think it'll go with the market, which, you know, maybe with where the market has been already this year is going to be range bound as well. But having said that, look, all of these stocks, just about all of them, are trading at a roughly low 30s multiple going forward. And you have to look against the growth rate as to whether that multiple is justified or not. And we talked about Amazon a second ago. They've got a mid-20s earnings per share growth rate going forward projected. Apple's, on the other hand, is around 12-13%. So which one do I want to own? I want to own the same one at the same valuation that has the higher growth rate. I can't see any reason that Apple will break out of that 12 to 13% growth rate. Yes, we understand Apple Intelligence, but it's not leading to the super cycle upgrade. The one thing that Apple has going
will or if it won't. I mean,
at least not yet.
I hear you, but it's so early. It's so early in the rollout of Apple Intelligence, there would not necessarily be a real compelling reason that it would. As the rollout got more delayed, so too then probably does the upgrade cycle. But there's always an upgrade cycle for these products. Because there is, because of the installed base being more powerful than arguably any other consumer product company in the history of the world.
That's the 12 to 13% growth rate, is there's always an upgrade cycle. The super cycle, if it happens, and maybe it will, maybe it won't, but it hasn't happened yet, it's not projected to happen in the near term, is what would take that growth rate higher. I don't see it happening anytime soon, which is why I'm not big in the stock. There is one huge saving grace for this stock, which is the amount of shares that they buy back. Otherwise, I don't think it would deserve to be in the low 30s for a forward multiple.
Weiss?
You know, it's not only the growth rate that Apple should trade off of, and it's not what it does. It trades off the brand. It's got a, you know, their revenue stream is repeatable, right? It's happening every year. That's true of cloud also. But I don't think you have to own it because it's going to be range bound for a long time. Now, I do believe, and I do own it. I own a very small position because I sold some. Now, I do think the upgrade cycle will happen, but I've been thinking about it a lot. One time I thought it was going to be like unbelievable, going to blow the doors off. But, you know, each of their products that they have there keys off another product. So if it's search, it's not their own search engine. It's either going to be Google or pick another one. So what are you actually going to be able to do with your iPhone that's really going to blow you away? It's going to make it more efficient to use. You'll be able to do some things, but it's
what
almost
else
like
do you want
a new
from
camera.
a phone? I mean,
exactly
you want it to teleport you somewhere? I mean,
that's exactly my point.
Why does it have to?
Well, it has to because you want to drive new phone purchases.
Well, you will, though, through these, whatever innovation that Apple Intelligence is going to bring. I don't know where the expectations are that it's going to be some sort of overwhelmingly transformational technology that's going to completely change, your day-to-day existence.
You're making my case for me. That's the case. Okay, the case is it's not going to do all that much for you. So why do I have to upgrade my phone? No, it's not going to do enough. It's not going to do enough. It's not going to do any more than these camera enhancements. So that's going to be the same cycle we've seen, et cetera, et cetera.
Why do you own the stock? We have this conversation, I feel like, every 3 to 5 years.
Because it's better than cash. I mean, it's a cash proxy for me. It's better than cash.
Josh, sorry. My deep apologies.
Downtown,
I was waiting for that.
Downtown Steve
I was waiting for that.
Sincerely.
Look,
Josh.
Apple is not flawless, and Apple makes mistakes, and Apple tries to correct those mistakes. Sometimes, in hindsight, the Vision Pro is a really great example of the fallibility of the company. But I do have to say, I think Apple has earned the benefit of the doubt that we might not be blown away by version 1.0 of anything, but by the time they get to 2, 3, and 4, these things become more than just luxury gadgets. They become staples in our lives. The AirPod and the watch are great examples.
My point exactly. So, they've never been the first mover in anything. They've just been the best.
No, it's not the goal. But I want to say something I think even more important to this discussion, which is Apple is overweighting safety and privacy relative to all other companies that are in this huge rush to be first, to be fastest, 1.0, 1.5, 2.0. Apple's going in the opposite direction. They're going to roll out incremental things very slowly, test them, see how they go, and then incrementally roll out more. They've said it, and they have always been the most trusted brand when it comes to safety. That is Apple's entire raison d'etre when they innovate. So this idea that they're late, they're behind, it just flies in the face of the last 25 years. We know they don't want to be first, and we also know they don't want to have a disaster on their hands. So conversational Siri is going to be the thing, Mr. Weiss, that makes you want to update your phone. And then after that, Siri as AI agent. Imagine being able to tell the AI to go buy you tickets for the Knicks game tonight, make me a reservation, let my wife know I'll be 15 minutes late, et cetera, et cetera. That's what's coming. It's not coming tomorrow, but I think people will upgrade when it arrives.
All right.
I can do some of those things now, by the way.
Mm-hmm.
Hey, Siri, text Lauren, tell her I'll be 15 minutes late.
Great.
Probably an often.
Imagine a two-way conversation that way.
And often text.
And she's going to say, why is he going to be so early? He's usually an hour late.
Hey, before we take our first break, I do want to get to a move from Josh. And you sold PayPal. Can you tell us why?
Yeah.
Most importantly, tell our viewers why.
I bought it at 70. I sold it at 83 on Tuesday when the earnings came out. I got out of it basically because I thought the trade had been made. I thought the earnings report was good, not great, and the stock had run up a lot. So if you get into something on technicals with a specific catalyst, I think you got to honor the discipline. I don't do a ton of trading typically, but that one was a trade, and the trade worked.
All right. Stock's down near 3%. We'll follow it, obviously. And we do have another move from Josh. It's a new buy. We will detail it next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Welcome back. I told you Josh had another new move. In fact, he does. It is a buy, and it is, Mr. Brown?
Baker Hughes, ticker BKR. This is one of the best performing stocks in a sector that's performed terribly this year. And this one popped up on our list of the best stocks in the market on October, I think 13th or 17th, and it's stuck around over the last couple of weeks, and it's actually been building in strength. So basically, this is one of only 10 positive stocks this year in the S&P energy sector. It's the 8th best performer in the group, up about 10% year to date. They're expecting to grow earnings 44% over the year. It's the 3rd highest earnings growth rate out of the sector. That's probably why it's outperforming. I think what's really interesting here is that $38, $39 level. If you take a look at a 5-year chart, you can see clearly that was an area where the stock struggled a couple of years ago. We're 30 months later about to retest that area. And if she breaks through, there really aren't any sellers in the name. Everyone would be positive. You've got an RSI in the 60s, not overbought yet. So it'll probably struggle with that $38, $39 area. I'm anticipating the breakout here, but I think it's one of those situations where it's a really high-quality company, not expensive, clearly diverging from the rest of the OIH. And when you listen to what Chevron and Exxon said this morning about their plans to spend, all of that money goes to companies like Baker Hughes, which is oil field services giant. So I like the stock. I like the business as well. Looks really healthy, and I think it could work.
Okay. Bryn, what do you think?
Yeah, I think that's a great assessment of Baker Hughes. I think also it's interesting. I mean, we own Viper, which is probably one of the best performing, if not the best performing in the energy space, which is mineral rights, up 66%. I think really we want to see more China stimulus. To me, that's the catalyst that we're going to need to actually get the sector writ large to go higher towards the end of the year. So we'll see what happens after the election next week. If